G'day everyone, and welcome again to this ShareCafe Hidden Gems webinar. Not much for me today. We've got 5 companies presenting. There's obviously a bit of pain in the market for shareholders. Don't be afraid to sell stocks where there is a loss. Realise that capital loss against some of your capital gains. You can always buy that stock back in the market. That's an old trick as a tax position pre-June 30. Righto, first up, now don't forget to ask questions as well. First up, we have Antisense Therapeutics, ASX code ANP, market cap of around $95 million. The company is a biotechnology company developing and commercializing antisense pharmaceuticals for large unmet markets in rare diseases, in particular Duchenne's muscular dystrophy in boys. We have with us, and welcome back, Mark Diamond, who is both the CEO and Managing Director. Over to you, Mark.
Well, thanks, Tim. It's a pleasure again to be presenting on Antisense Therapeutics and updating the market on what I think has been a stellar performance of the company. So, first slide here, you'll see our key financials and a company overview. As Tim mentioned, with a market capitalisation of around 100 million, with a very strong balance sheet with no debt, and you'll see that we reported at the end of March we had just over $8 million in the bank. The company is laser focused, as it were, in developing its pipeline of antisense drugs for diseases where there's a clear need for better therapies, and where our antisense drugs are shaping as being superior therapy for addressing those disorders. So what is really unique about Antisense Therapeutics is that the drugs that we have in our pipeline, we've actually acquired them from a much larger pharmaceutical company based in the US. And this is a company called Ionis Pharmaceuticals. For those who don't know the company, they have been working with antisense technology for over 30 years, and they are clearly the leader in development and commercialization of these antisense molecules. And so we have worldwide exclusive licenses from Ionis to 2 drugs that we are looking to develop and commercialize. A little bit more on Ionis. They have now 3 approved drugs. One of those is a blockbuster drug that they've partnered with Biogen. Last quarter sales were over 500 million, interestingly, and I think very relevantly, being developed for a rare disorder in children called spinal muscular atrophy. And that drug is actually on track to be a $2 billion selling drug. And it's again in a rare CNS disease in children. So we're very fortunate to have partnered early in the game with Ionis, who now, since we've set up our relationship, have collaborations with companies like Pfizer, Roche, Bayer, AstraZeneca, and as I mentioned, Biogen. So we are an elite company in looking to develop and commercialize that technology. And I think that is a feature of the company. Perhaps it's been underestimated by the market. Major shareholder is Platinum Asset Management. They are a global equities investment firm, 25 billion under management, have a dedicated healthcare fund with international fund with $600 million portfolio. So again, we think that's a tremendous validation of Antisense Therapeutics, given that they've come in, been supportive of the company, been a major shareholder now for over 3 years. You'll see there on the slide, we've listed the very broad-based analyst coverage. Those names, for those familiar with the biotech sector, would see them as being recognised as the sort of most experienced and the highest profiled sell-side analysts in the sector. So again, very significant validation, we believe, for the Antisense story, seeing each one of those analysts having positive buy recommendations on the stock. And you can get onto our website to see those research reports. I'd encourage you to do that. The lead program, as Tim said, is for this rare muscular disease in boys, young boys, called Duchenne muscular dystrophy. We're sitting in an exceptional position with a very positive phase 2 clinical trial data. Go to the next slide. Thanks, Tim. And I think when it comes to contemplating our lead program, I really do believe that this program is unrivaled. As you line it up with any biotech peer locally, or I think even be fair to say internationally, and I think it's evident through the features of the program that we've listed here. We have a novel and differentiated mechanism of action of the drug. We're the only company in the world that's developing a drug that's targeting a known actor in the inflammatory process of human disease. And we've shown that drug to be active in boys with Duchenne muscular dystrophy. But we also think it's got very broad application across a range of inflammatory diseases. We're in a market where the only therapy that's available to treat boys today is a drug that was first approved 60 years ago. Modest activity, but comes with a litany of side effects. So we really do think we're uniquely positioned with a drug that can be more effective and safer than the only therapy that's available for this patient population. Our mechanism of action, it allows us to consider our drug being used as a monotherapy or to be used in combination with existing drugs that are on the market to treat Duchenne's, and also those that are coming through development. So we think that positions us where we can avoid head-to-head competition with other drugs, and giving ourselves an opportunity to sort of benefit from the high levels of market penetration that come when you've got a drug that can be used alongside other therapies for treating the disease. Positive phase 2 clinical trial data that's been recognised by experts in the field, regulatory authorities that we've presented it to, and an outstanding IP position, not only based on the patents that we filed ourselves, but recently receiving orphan drug designations in both the EU and US, biggest pharmaceutical markets in the world, where we get additional market exclusivity. So, we're playing in a market in Duchenne's that's thought to be valued by 2030 as high as 10 billion, with very limited competition. Next slide, thanks, Tim. So what is Duchenne's? As I mentioned earlier, it is a rare genetic disorder of boys. It's caused by a faulty gene that prevents these boys from being able to make enough of a key protein for muscle function called dystrophin. The lack of dystrophin in the boys' muscles leads to inflammation in the muscles and associated fibrosis, and eventually to the death of the muscle tissue. It is a rare disease, but it actually has the unfortunate reputation of being the most common lethal genetic disorder. So its prevalence is quite significant. The key challenge for these boys is to try and dampen down that inflammation in the muscles that leads to the progressive muscle loss. And so, as I mentioned earlier, the only way that's being treated today is by using a category of drugs that have been used for 60 years. They're very blunt in the way in which they work, modest activity, and cause some very serious side effects. But having said that, because they're all the only game in town, physicians are starting boys on these therapies as early as 2 years of age. So there really is a desperate need for a better way to address the therapy. That's what we think that we have in our portfolio here. Next slide, thanks, Tim. So we ran a phase 2 clinical trial here at the Royal Children's Hospital in Melbourne, and where we came out with excellent preliminary phase 2 clinical trial data. And I might just pause there, because those that are investors in biotech would ask them maybe to contemplate those companies that they are invested in at the present time, and how many of those would have positive phase 2 clinical trial data on showing benefits on the endpoints that would be relevant to the approval of a drug. I hazard to say very few companies, and I think the importance of that is that the significant de-risking that we brought by being able to deliver on this phase 2 clinical trial data. Many companies fall over at this point, and we set ourselves up here, we think, in a very exciting fashion to be able to advance the program towards commercialization, with the de-risking of being able to say our drug's actually working in the disease that we're looking to treat. I won't go into the details of the slide here and the data that were presented. The quote there really does encapsulate what we've delivered on. We've positive data across multiple measures of muscle strength and function in these boys, and really setting us up for the next phase of development of the drug. Next slide, thanks, Tim. Speaking of which, this is the next steps in the development of H1102 for these boys with Duchenne's. We're planning a phase 2B clinical trial that we're looking to conduct in Europe. We're well advanced in that planning. We've had multiple interactions with the European regulatory authorities. We submitted last month what's known as our Paediatric Investigational Plan, which had the synopsis for our phase 2 clinical trial. To point out that this phase 2B study that we're looking to run, we are, and all the dialogue that we have with the European regulatory authorities is to set it up as a potentially approvable study. So this next study could get us an approval, what's known as a conditional approval in Europe. So as I've emphasised before, potentially one study away from being able to market the drug in the second biggest pharmaceutical market in the world. So we are waiting for feedback on that PIP submission to what's known as the Paediatric Development Committee of the European Medicines Agency. Subsequent to receiving that feedback, we'll be looking to submit our trial application. We're expecting to do that this quarter. First approvals to come through in the third quarter, be able to start the study in the fourth quarter of this year. Again, a study that could see us an approval. And to point out that the endpoints for those studies are essentially the same ones that we've been able to show positive activity on in our 6-month study that we ran at the Royal Children's Hospital. In parallel with our plans for advancing the drug in Europe, we've been moving forward with our planning for the US. Positive interactions recently with the FDA through a Type C meeting. Looking forward to be able to come to market with further details of that at the end of the month once we get the official meeting minutes, as I said, due at the end of May. Next slide, thanks. Not time really to go into the development landscape. Just 2 key features I'd highlight. Very limited competition in the non-ambulance space where we're playing. One only company that has an active clinical program. The other point is we expect our drug to be able to be used in combination with existing therapies and those that are in development. So we think we're sitting uniquely in terms of our competitive position. Next slide, thanks. We are very excited about the drug's potential application in other inflammatory diseases based on the data we've developed to date. We've been filing new patents around its application in those other diseases. We really like the opportunity to expand in the neuroinflammation, neuromuscular disease area into the rare disease applications where there's a need for better therapies, being able to move forward into clinical trials that are less expensive and quicker to move towards commercialization. But we still see this drug as having, potential in some of the larger disease indications as well too. So this is really something, for our shareholders to look forward to as we advance the program beyond Duchenne's. Next slide. Again, really no time to go into market details on the call here today. Just point out a couple of key features. I've already talked about the DMD market, 10 billion by 2030. The global anti-inflammatory market, one of the biggest pharmaceutical markets, I think just second to the cancer drug market. It's going to be $200 million market by 2027. Both markets that we think will be able to take a substantial position in. We undertook a peer comparison with some selected companies in the US. So peers listed on NASDAQ, you'll see there, value between 160 US to 2.5 billion. So we still think there's lots of value there to be delivered based on where we are today, let alone the news flow that we're expecting to see. Speaking of which, go to the next slide. Just wanted to point out, in the last 12 months, we've delivered on 11 key milestones, 11. So again, have a look at companies that you're backing. I venture to say that we would be in rare company indeed by being able to show that we could deliver on that level of catalyst drivers, but also news flow. We've got some key ones coming up in the next quarter, and I think that this, our ability to deliver as we have done in the last 12 months, reflects the experience and the dedication of the Antisense team, but the benefit of us working on a platform technology, as I said, where there's already a $2 billion selling drug on the market. And I think the next slide, thanks, Tim, the last one for me, talks to I think the confidence that investors should have in our ability to be able to deliver on these key near-term catalysts. And they are around advancing the program with the US regulatory authorities, moving forward with the successful manufacture of our drug compound for phase 2B clinical trials, coming to market with news on our new indications, so adding value beyond what we've already delivered in Duchenne's, and also the advancement of our program into this phase 2B study in Europe, which is, we are endeavouring to deliver on, could be an approvable study. And so, Tim, I'll stop there and take questions.
It's a big story for 10 minutes. Thank you, Mark. Now, you've just recently made some senior appointments in regards to the board. Dr. Charmaine Gilson from ex-CSL, Professor Tom Voigt, and then there was Dr. Gil Price that we spoke about. Now, can you tell us a little bit more about Dr. Gil Price in particular, given his background with Sarepta and how he built that from a $80 million company to a multi-billion-dollar company in a very similar space?
Yeah, thanks, Tim. And that is really a significant appointment of the company. So Gil is, our US-based consultant medical director, and he was an ex-director of Sarepta Therapeutics. Sarepta Therapeutics are the biggest player in the Duchenne world. They've got 3 marketed products in the US, addressing only, I think, 20% of the Duchenne's market, but today selling, I think, on track to sell over $500 million US annually. And Gil, as you correctly stated, Tim, was there on the ground when the company had started their program in Duchenne's muscular dystrophy. And so, in fact, I think the market cap might have even been less than what you stated, 80 billion. So, along with Gil, of course, we had the ex-chairman of Sarepta, Bill Goolsbee, who's on my board as a non-executive director. And both Gil and Bill were there, when they started the program in Duchenne's and advanced it all the way through to approval, first approval in the US, and saw the company's market cap run from, the 60, 80 million up to, I think it peaked at 3 billion on approval, of the drug in the US. So, look, very excited to have both of those executives involved in the business. I think if they're on the call today, they would say that, that the reason for, partnering with a small biotech company other side of the world, having to deal with the challenges of the litany of, time differences, is because of the potential that they see in our drug and ability to repeat, what they did at Sarepta. So, thanks for pointing that out. Time, doesn't prevent for us to, present as an opportunity to talk about who's in the company and who's supporting us, but they are 2 key appointments, along with Charmaine Gilson, who you highlighted, who's just come onto our board as a non-executive director. Charmaine was medical director at CSL, and in her time there was running their R&D portfolio of over 400 staff globally, and an R&D budget of 400 million. So we are the first company, Tim, after retiring from an executive role, a public company that she's gone onto the board of. And she brings her very relevant rare disease experience, but very, very deep knowledge of product and drug development. And again, I think that appointment does, speak highly, I believe, of the qualities of Antisense Therapeutics and the potential. But also, the confidence that these executives have on our ability to deliver on our plans.
Great, Mark. That's all we have time for. Great to have you back. Have a nice weekend, and we'll chat soon.
Thanks, Tim. Good luck with the rest of the program, and thanks for the opportunity.
Thank you. Next up, we have Lindsay Australia, ASX code LAU. It's got a market cap of around $107 million, a one-year return of up 4.3%. The company is an integrated transports, logistics and rural supply company. We have with us, we've got a bit of a team there in the boardroom. We have with us Lindsay, who's the CEO and Managing Director, and Justin Green, who is the CFO. Over to you, gentlemen.
Thanks, Tim. Thanks for the opportunity to present today. I'm Lindsay, CEO of Lindsay Australia. Presenting with me today is Justin Green, our CFO, and Matt Heffron, our group analyst. I'll give you a brief overview of the business, then I'll hand over to Justin to discuss our recent results and financials. Skip to slide 3, please, Tim. Lindsay Australia was founded in 1953 as a small transport operator in Coffs Harbour. Today, the business turns over more than 400 million revenue as a fully integrated logistic business, providing a unique end-to-end solution for over 3,000 customers who are primarily in the horticultural industry. Lindsay has 3 companies in our divisions: Lindsay Transport, which operates one of the largest refrigerated fleets in Australia; Lindsay Rural, one of the largest independent rural merchandise business in the country; and Lindsay Fresh Logistics, a logistics specialist in the Brisbane markets who focuses on imports and exports. By combining the divisions, we can offer our customers a unique end-to-end solution with the ability to help grow their produce, as well as package, transport, and distribution through their products throughout Australia and the world. Transport is Lindsay's largest division, accounting for 70% of the group's revenue. For nearly 70 years, Transport has been a road-only operator, but in 2015, we diversified our services, purchasing our first refrigerated rail container. Rail now makes up 20% of the division's revenue. Slide 4, please, Tim. Lindsay has over 40 transport depots and rural stores across the country, primarily servicing the East Coast. Most transport depots are unique with specialised cold rooms. Our network reaches from Perth in Western Australia to Mareeba in far north Queensland and can be found in most major growing regions across the country. Slide 5, please, Tim. Lindsay has been public listed since 2002 with a market cap of 108 million at the last close. Many of our shareholders have been supporting us for several years, which is why we are committed to giving back to them. Lindsay has a strong track record of paying dividends with a yield of around 5 to 6% in recent years. I'll now hand over to Justin. Thank you.
Thanks, Kim. Thanks, Tim, and everybody for the opportunity to present the Lindsay story today. I'll touch base on the group's financial performance and cover off some key points from each of our divisions. For the half year ended December, the group experienced some flat revenue growth, but despite the flat revenue, we had some material improvements in our underlying margins. So the improvements in the margin flowed through to deliver a record half year EBITDA and strong double-digit performance across a number of our other financial metrics. And importantly, the half year, despite some of the challenging environments throughout COVID, delivered us a fairly strong balance sheet with a significant amount of cash. As a result of the strong performance, it was pleasing that we were able to increase our half year dividend by 20% to 1.2 cents per share. And this is next slide. Thanks, Tim. This is the third consecutive year now that the group's experienced a material increase in our half year EBITDA. And I think that shows that the strategy that we implemented 3 years ago with our rail is starting to pay dividends. Importantly, this result was supported by the strong performance, not only by transport and rural, but some reduction in our corporate overhead costs as well. Our focus remains on the balance sheet, and we focused on the balance sheet to put us in a position that we can take advantage of opportunities in the coming years when they arise. A number of the key metrics are included on your slide 7. The group continues to invest for the future. In the past 3 years, we've invested close to $90 million on new equipment and expanding our major refrigerated facilities. Our CapEx strategy is relatively simple: safety and to deliver shareholder returns. We operate a relatively simple growth philosophy: expand rail, expand rural, and renew our road fleet. The debt profile is pretty typical of our logistics business, in that almost 80% of our debt is made up of individual equipment finance leases for trucks, trailers, and refrigerated containers. We operate a small amount of corporate debt, and that corporate debt's used primarily to fund freehold facilities and the fit out of some of our major refrigerated facilities. Next slide, thanks, Tim. I'll touch briefly on each of the divisions. Transport is the largest, as Kim mentioned, of our division. Annually, we have approximately 300 million in turnovers from this division. For the half year, Transport delivered a very strong result and was supported by the organic growth that we're achieving in our rail strategy. Transport operates an extensive network, not only in the horticultural areas, but in all our major capital cities. Transport operates close to 300 interstate prime movers, and we have 700 trailers, primarily refrigerated, in the fleet. In 2015, we started our rail strategy, at which time we had 0 refrigerated rail containers in our fleet. That half year just completed, we had 231 refrigerated containers owned, and we also operated a number of hire containers due to the delays in some of the importing of the new equipment. By June 2022, our focus is to increase that rail container fleet to almost 400. But although the rail remains a key organic growth strategy for the group, it's complementary to our road strategy. What we'll find is it gives us an opportunity now for tenders. Previously, before 2015, we would have large supermarket chain tenders, and as we didn't operate a rail service, we were only tendering on the road service. Now, as a fully integrated logistics business, we can operate both road and rail and provide unique service offering to our customers, in that if either one of those services are out for whatever reason, whether that be fire, flood, cyclones, or potentially train derailments, we can offer that unique service, and that we can still move their time critical freight. Customers are loving it. It gives us a strategic advantage when we're in these tenders. We can offer the lower cost, and traditionally rail is a lower cost model for the customers, but we can supplement that with the high service model of the road fleet. And we will continue to expand that rail to help us diversify some of our seasonality risk that comes with the horticultural business. Next slide, thanks, Tim. Lindsay Rural is probably the unsung hero in the group. Kim started the Lindsay Rural business almost 40 years ago. It operates as one of the largest independent resellers and a direct competitor to the majors, which is Elders and Nutrien. Lindsay Rural is not aligned to any buying group. They source their product directly from overseas and from all the major chemical companies and all the major fertilizer companies. Lindsay Rural turns over approximately 130 million annually. And our philosophy is to offer a high service model to the small to medium range customers that value that service model. The advantage for Lindsay Rural is that no other rural merchandising business has a transport company, has a logistics division the size of Lindsay Transport, which puts us in a unique position where our speed to service for these customers is unmatched by any other competitor. Over the last 3 years, we've been on a bit of a journey for Lindsay Rural, and we've basically we call the model back to basics. We want to reduce our cost to serve the customers. We're increasing our sales team. We focus on high growth horticultural regions where we've been underrepresented, and we're increasing our share of wallet for each of the customers. We're going to continue to expand this model over the coming years, and in the last 2 months, we've recently opened a new branch at Woolgoolga in New South Wales, which also complements our transport operations in that area. Next slide, thanks, Tim. Lindsay Fresh, as Kim mentioned, based in Brisbane and specialises in import and export logistics. But more importantly, for Lindsay Fresh, it offers a much more vast range of services. Lindsay Fresh is a one-stop shop for import, export, and all the requirements, whether that be fumigation, cold chain, labelling for all our customers. Now, Fresh also complements the transport operations, giving our customers, a single point of contact to get their produce from farm to wherever that produce is going, whether that be intrastate, interstate, or international. I appreciate the time to present. I'll hand back to Kim now to talk about the group's growth strategy and our outlook.
Thanks, Justin. Our growth strategy, as we touched on throughout the presentation, our current strategy is relatively simple: continue to grow transport by expanding the rail fleet and also upgrading facilities that are operating at capacity. Rural will continue to elevate new low-cost retail models in key porty areas, while Fresh will continue to benefit from the recovery of import and export markets. The outlook overall, Tim, the next slide. Overall, our outlook for the business is positive. We expect to maintain our half-year EBITDA guidance of 12% growth on the previous year. The business balance sheet remains strong and will allow us to continue to grow and return value back to our shareholders. We have a proven track record on embracing and overcoming challenges. I'd just like to thank you for your time and any Q&A. Thank you.
Thanks, Kim. And you just mentioned challenges. What's the environment been like lately with, we've had COVID to start, COVID now and floods previously. Can you talk to how you adapt in those sort of environments?
COVID was very challenging. Yeah, we had March, April, May, June last year that we had 3 to 4 months where the business was absolutely turned upside down to where we were in there. The freight volumes were very strong out of the capital cities. The produce wasn't running strong at that time. We managed to work our way through that. We got into July before we really got back to some kind of normality. The challenges at the moment is finding staff. Very hard to find staff out there at the moment. We're finding our Horty guys are having the same issue finding pickers. We're very lucky. The Horty prices are great prices at the moment, so it's compensating for some of the volume not going out. But if we had a challenge going forward, is really about labour.
And you've attracted some significant shareholders. You showed on a slide there. You've got Soul Patterson's, you've got Milton, BKI Investments. I think that's the old Brickworks. Or what's your policy? I mean, they're value investors. What's your policy around dividend growth for investors?
Look, we look at paying 60 to 70% out every year across the board, and we'll stay to that as we grow through the business, as we get more profitable. But having shareholders like the Souls, BKI, Milton Group, they've been with us since the day we floated. They're very strong. Get behind the business, and we're probably very privileged to have them as shareholders.
Certainly are. And so can you talk us through what's your view as sustainable in terms of your long-term revenue mix between road, rail and rural?
Yeah, look, our rail business is growing at double digit every year at the moment, and we see that continuing going there. And why have we gone rail? If you have a look at the average truck driver age at the moment, is 59 years of age across the industry. It's very high, and we see that if we don't change now, and what we have been doing the last 3 years across the board, we'll get to another 3 or 4 years, and we'll have an age of truck drivers, when they're 63, 64, starting to retire, we won't be able to move the volume of freight. We're back to back with Pacific National. They're a good company to deal with. We want those double-digit growth to keep going that way. And to give you some idea, last year we did mangoes out of Mareeba, which is above Cairns, into Perth by rail. At 7.5 days, absolutely turned up fantastic. We've built the rail containers coming out of China. We fit them out here. They're as good as any refrigerated trailer we've got running around Australia. We've got live chickens, I should say fresh chickens, going to Perth out of Adelaide, and we've got prongs in the chicken so our customers can see the temperature of chooks as they're going across the nullarbor. So the technology is quite amazing today, what we've the money we've spent to do this.
Anything I'll add to that, Tim, is 5 years ago, if you tried to move produce on rail, you wouldn't have a customer. They would never deal with you again. Now what the time is if you don't have that rail offer, it's going to hold you back in the future. So we've probably been leaders in that area. We treat rail containers no different to how we treat our road fleet. Optimal utilisation rates. So having trucks sitting down or containers sitting down, we treat them no different. So if you don't have that rail offer in coming years, and as Kim mentioned, there's challenges with capital city congestion. There's challenges with driver shortages. There's challenges with just the road network that we're operating on. If you don't have that rail option in the coming years, you're going to struggle to be a key competitor in the sector.
And just the last question, if you don't mind. So what's kind of coverage of the Australian market do you plan to have in the next couple of years?
In the hoarding industry, we're one of the largest in the hoarding industry, but across the whole Australian market, we wouldn't be 2% of the market.
Yeah. So there's plans to grow that?
There's a lot of opportunity to grow, but we're just not going to grow for revenue.
Understood. Okay, gentlemen, that's all we have time for. We love to hear an Australian success story. Good luck out there. We'd love to have you back on later in the year.
Thank you.
Thanks, Tim. Appreciate your time.
Thank you. Next up, we have Noxo Farm, ASX code NOX, market cap 145 million. We have with us the CEO and Managing Director, Graham Kelly. The company is a clinical stage drug development company. Graham, we welcome you back. I think you're still on mute there. Over to you. Thanks for your time.
Thanks, Tim. It's good to be back on the platform again. I guess the major starting fact about Noxo Farm is it's a drug development company currently in its 6th year of operation. Next slide, thanks. We have a technology platform which we developed ourselves and we own outright, and it allows us to focus on 2 main areas, cancer and septic shock. Now, everyone knows about cancer, obviously, but fewer have ever heard of septic shock. This is despite the fact that they both kill about the same number of people each year. And between them, they account for about 40%. That's 40% of all deaths worldwide from disease. Now, the term septic shock refers to the body going into a potentially fatal shock as a result of an infection or sepsis. So the infection is the sepsis, and the outcome is shock. And the example that you see here is an infection of the lung. Now, the death from septic shock isn't coming directly from the infection. It's the result of the body overreacting to the infection. And that triggers a shock where the blood pressure collapses catastrophically. That leads to failure of the body's major organs. Now, in 2019, there was an estimated 10 million people died worldwide from septic shock, mainly from various viral infections like influenza, but also parasitic infections like malaria. Now, last year, to that 10 million people, we can add another 2 million people who died from septic shock due to the coronavirus. So septic shock is very central to the current pandemic. Next slide, please. So you might well ask, well, what's the connection between cancer and septic shock? Why do we have a platform technology that might be relevant to both? And the answer is that both septic shock and cancer involve abnormalities of the immune system and inflammation. In the case of cancer, the cancer cells actually manipulate the immune system and inflammation to their advantage, and that aids their growth and ability to spread around the body. In the case of septic shock, the problem is that the body's immune system has overreacted to the infection. And it turns out that both of these scenarios share a family of enzymes or biologies in the body that are misbehaving. And we've identified a family of drugs that block the enzymes involved in both of these scenarios. So that's the common link. Next slide, thanks. Now, after 5 years of testing, we're confident that we know how our technology is working, and therefore what its main commercial opportunities are. And this has led us to settle on the business structure you see here, which starting from the left, you see our main business currently is to develop our first drug, Vyonda, as a way of boosting the effectiveness of most common forms of cancer therapy. And I'll be enlarging on this in a minute. The second business is to develop a pipeline of cancer drugs, and this is an entirely new concept in cancer therapy. It involves not just killing the cancer cells, but also stopping the surrounding healthy tissues from helping to drive the aggressive growth of cancers like pancreatic cancer and brain cancer. And this, in fact, is a particularly exciting venture within the company. The third one along involves the use of Vyonda to treat septic shock. And the fourth is to build on the way that Vyonda prevents septic shock by developing a whole new family of drugs that we hope to treat chronic inflammatory diseases such as rheumatoid arthritis, as well as autoimmune diseases such as motor neurone disease. And this fourth opportunity sits in a fully owned subsidiary of the company called Pharmarage. Next slide, thanks. And given our limited time today, I'm just going to focus on the aim of developing Vyonda as a general booster of common cancer treatments. What you see here are the 7 major ways that doctors currently treat cancer. And of these, our aim is to see Vyonda become a standard companion treatment with the 4 on the right that provide the backbone of cancer therapy. Now, each one of these treatments, chemotherapy and radiotherapy, for example, is limited in its effectiveness. You have, with most patients, the cancers either start off not responding to any of these treatments, or they do respond initially, but they eventually stop responding. So regrettably, once you develop metastatic cancer, it's not a question so much if you will die, it's a question of when. Now, all of these 4 ways are in urgent need of help. And that's what we are developing Vyonda to provide. Next slide, thanks. So we've got 4 clinical programs running. SEP is about making Vyonda, about using Vyonda to make common forms of chemotherapy work better. Ionic is about combining Vyonda with the exciting new generation of drugs known as checkpoint inhibitors. This is the so-called immuno-oncology sector. This particular program is being co-sponsored by Bristol Myers Squibb, the large US pharmaceutical company. The third one, DART, is about combining Vyonda with standard radiotherapy. And the fourth one, Lupin, is about combining Vyonda with targeted drug therapy, which involves using a radioactive drug which is injected intravenously. And that trial is being co-sponsored by Novartis, which is the 4th largest pharmaceutical company in the world. So this is what we call our 4 pillars oncology strategy. So we're covering all 4 major forms of current cancer therapy. And you can see at the bottom the commercial value of each of these treatment sectors. So if Vyonda is successful in boosting the value of any one of these sectors, then it potentially puts the value of Vyonda into the billions of dollars. And of course, if we can do 2, 3, or even 4 of all these things, then the potential value has just become telephone book numbers. Next slide, thanks. Now, I can't stress too much just how novel and highly ambitious is this aim for Vyonda. To our knowledge, nobody before has aimed this high. That is, having one drug work across most forms of cancer therapy. And the reason is that nobody before has had the means of addressing what we and a lot of other people regard as the major reason why current cancer therapies struggle to work. And that is that most human cancers or tumours are what are known as being cold. And that simply means that the cancer cells have kicked the immune cells out of the tumour, and that just allows the cancer cells to thrive in the absence of any immune function. Immune function is what kills cancer cells. Get rid of the immune function, the cancer cells are free to grow. So under that sort of scenario, regardless of what damage your treatment is inflicting on the cancer cells, without the immune cells present to take advantage of that, the treatment is just that much less effective. And Beyonda corrects this problem by driving the immune cells back inside the tumour. And this is called converting tumours from cold to hot. And it is a major search currently within the global pharmaceutical industry. We believe we've achieved it, and that's why we believe Beyonda has the capacity to succeed where others have failed. Next slide, thanks. So we've performed clinical trials with 3 of these pillars. That's with chemotherapy, with radiotherapy, and then with targeted radioactive drugs. And in each case, we've produced what the company believes is early confirmation that Beyonda has provided a boost to the other treatment. There clearly isn't time here to run through the detailed data from all these trials, but we have reported those. They're in the public domain, and we're comfortable that we can say that we've delivered proof of principle, early proof of principle. So what we're now doing is taking to the next level by initiating 3 large studies over the next several months. So by the end of this year, we will have 3 quite large studies underway. Next slide, thanks. So in summary, I'd ask you to bear in mind that all our patients have late-stage cancers. These are cancers that have stopped responding to standard treatments, and the patients essentially have stopped being offered any anti-cancer therapy. And in almost all cases, survival is just a matter of months. So in that end-stage setting, we've seen clear proof of concept in each of our 3 clinical studies done to date that we're achieving what we set out to achieve, and that is Beyonda is making the other cancer therapy work that much better. And importantly, we've achieved that in a very well tolerated way, and Beyonda has not presented any safety concerns. So that's a major step forward in planting a flag in the ground and saying we're on our way. Now, we've got a busy clinical program. As I mentioned, we've got 3 trials about to start. Some of these are multinational studies involving the United States, Australia, and Europe. And that means that we're confident of a number of important catalysts coming over the next 18 months. And these trials that we're running are all open studies, open label studies, which means that we're able to report on them, present interim data as we're going along. So we're not about to enter a cone of silence for the next 2 years. And the success of Beyonda in any one of these programs carries the potential for major commercial success. And as I said earlier, if we can achieve success in more than one, then we believe Beyonda will become one of the most cleanly sought after assets in the pharmaceutical industry. Next slide. We're well funded, and we've got the cash to carry out our programs. And again, the news flow is looking particularly strong over the next 12 to 18 months. Next slide. So I'll end there, and I'm happy to answer any questions. Thank you.
Thanks, Graham. You're talking a big picture here with Beyonda having kind of multi-purposes, if you like. Can you talk a little bit more about how you partner with some of these pharmaceutical companies, these global pharmaceutical companies, in relation to getting some data back?
Sure. Well, about 20 or 30 years ago, almost all drug development came out of the big pharmaceutical companies. They all ran, huge drug development programs. That's swung around now, where the vast majority of drug development comes out of companies like Noxopharm. So the big boys are relying on the smaller companies like us to be smarter. We're a little bit more nimble. We're less risk averse than the big boys. We can afford to take risks, and we're more creative. So they're relying on companies like us. And in the case of one of the programs we're running, just give that as an example, our Ionic study, and this is using a Bristol Myers drug called Opdivo. Now, last year, Opdivo did about $8 billion worth of business, and it accounted for 30% of that company's revenue. Now, they're losing ground. Bristol Myers is losing ground with their drug to another company, Merck, which has a similar drug, and so they're looking to increase the ability of their drug to work in patients. And unfortunately, most patients don't respond to either the BMS drug or the Merck drug. So all we would have to do is to find a way of increasing the response rate to their drug, their $8 billion a year drug, and I think they would be very happy. So BMS is working with about 10 companies worldwide that we're aware of, all looking to help make Opdivo work better. So we're in that race at the moment to make Opdivo work better. That's just one of the programs we're working with. So that, to answer your question, that's how why we're working with companies like BMS and Novartis, and we look forward to that relationship blossoming over the years ahead.
And when you do one of these trials, so you have Opdivo and Vyondra together, have you got any data to suggest that Vyondra actually improves the patient without in combination? I'm trying to work out how you determine the combination and the success of Vyondra relative to Opdivo.
Well, in the case of Opdivo, where our trial that we're about to start is taking patients whose tumours have not responded to Opdivo. So they've been given Opdivo. They will have maybe lung cancer or melanoma or bladder cancer, and they've been treated with Opdivo, and then the tumour has either just failed to respond at all, or it's shown a little bit of response and then stopped responding. So we know that the patient is not going to be responding to Opdivo. So if we then treat that patient with a combination of Vyondra and Opdivo, and that patient responds, then we can say with some degree of confidence that it's the combination that's done the job. That's where we're up to at the moment. Now, from there, in order to get our drug approved and put on the market, we would have to do a much bigger, a large control study where we would have to, we would go Opdivo alone versus Opdivo in combination with Vyondra.
And finally, there's quite a few questions here. Can you talk us about the IP position on Vyondra?
Sure. Well, we've got a series of families. We've got eight families of patents that are currently being examined. One of those patents has been granted in one country, and we've just learned that another patent, as all the claims have been accepted in Europe. So it's an ongoing process. We're at the start of it. We're confident that we will achieve solid IP coverage around Vyondra that will. It's the sort of coverage that you would, a big company like BMS or Novartis would require.
Great, Graham. That's all we have time for. Have a nice weekend. Always good to see you.
Thanks, Tim. Thank you.
Next up, we have Venture Minerals, ASX code VMS, market cap of around $138 million, a lazy one-year return of up 633%. The company is striving to discover and develop world-class mineral deposits. We welcome back the Managing Director, Andrew Radonojic. Andrew, over to you. Thanks for your time.
Great. Thanks to be back again, Tim. Again, just like to say, it's It's great to be presenting the venture story on here on ShareCafe, and it's going to be a pretty exciting year for the company as we become a producer with the O'Reilly iron ore mine kicking off shortly. But the company is much more than that. We've recently attracted a joint venture with Chalice, kicking off the joint venture work on a Julimar lookalike target in our Southwest project. We've been at Coolin, where we've actually completed a maiden drill program, following up some pretty exciting trench results we announced early this year. And we're currently drilling at our Golden Grove North project. But let's not forget that 10 years ago, Venture was completing a feasibility study on its Mount Lindsay tin tungsten project, and almost to the day. And last week, tin broke record prices of over $33,000 per ton, which it last achieved in 2011. So, yeah, so a lot seems to be happening in our space. Next slide, please. Yeah, market cap now is around about $150 million. So we've had a bit of a resurgence with the iron ore price and with the Chalice joint venture announcement just recently. Moving forward, please. Next slide. The board is the same board that we started off back in 2006. So we have all the experience and knowledge of our tin assets and our iron ore project in Tasmania, which we started working on back in 2007. So we're very blessed to have the same team on board, so we can bring this forward. These assets that we've been sitting on, waiting for these prices to come back. Next slide. Now a little bit about our iron ore project, Riley, there on the west coast of Tasmania. Next slide. Yes, as you can see from the map there in red, we've got the 120 kilometre long haulage route. It's all bitumen road from Riley to the port of Burnie, where we will ship up to 45,000 tonne vessels. All the permitting's completed. We have road and port access all signed, sealed and delivered. So we'll be able to start that shortly. Next slide, please. The Riley Iron Ore Project, it's like a FMG, super special fines product, very similar. It's only got 1.6 million tonnes. So it's timed well for this market. You can see the price is high. It'll be a couple of years of mining, so we can move quickly. We're on the verge of our first shipment, and we can take that advantage. But it's very simply top 1.5 metres thick blanket across the landscape there, so it's very straightforward process and no strip ratio. Thank you. Next slide. So where we're at now at the moment, we've got basically all the structural steel has been erected. We've got 80% of the mechanical installation completed, so we're at that final stage of putting the piping in. We've built a nice little team down there, lots of iron ore experience. Just recently, Jeff Halloran came on board, general manager. He's started 3 of this size sort of iron ore projects previously, so we're very fortunate to have him. And now our iron ore price is now $230 a tonne. So compared to the economics we put out back in August 2019, we made 30 million tonnes at a $90 price. Obviously, exchange rate is a little bit significantly lower as well, but still we're significantly higher than that today. Next slide. So upcoming milestones for the company, and you can see the commissioning of that plant's any day now. First haulage will happen shortly thereafter, and shipment towards the end of this quarter. So it's a pretty exciting phase for the company as we look to move from explorer to producer. Next slide. So now moving on to the Southwest project, the Chalice joint venture. Next slide. This is a joint venture we did back in July last year. Chalice was $1 a share back then. Obviously now it's around $7. And we signed that joint venture so we could get, I suppose, the IP, that Chalice had done from their Julimar discovery. So we got them to commit to a $3.7 million spend and 70%. At that 30% mark, Venture can hold its position. So funds from the Riley Iron Ore Mine, for example, could be used if we get onto another Julimar discovery. As you can see, the geology is quite similar in the similar part of the terrain, and also our cooling projects to the southeast of Julimar is not too far away. Next slide, please. The fact that the earning has just started this year, the first 12 months, we have $300,000 for Chalice to spend, and that's going to be done by July this year. So they're on the ground doing a significant ground EM program. and in the area that they have selected, Julimar lookalike type features in the magnetic anomaly at Tor. Beyond that, but they are actually doing work over airborne EM anomalies that we completed previously. So the chances, I suppose, of having drill targets coming out of the exercise is quite significant. Next slide, please. So this, I suppose, I call this the money shot here, and you can see that the mag anomalies are very, very similar between Julimar and Tor. I suppose that's what attracted them. Next slide, please. And what you see is that we have 6.5 kilometres of EM anomalies, very much exactly like Julimar. And those yellow lines there are the ground-based EM, which normally do the ground-based EM to sort of firm up your airborne targets. But back in 2018, Venture went ahead and drilled a diamond hole, and we got massive salt, 2.5 metres of massive sulfide, which had copper, nickel, and cobalt in it. So I suppose that's part of the reason why Charles is attracted. In fact, we've, have proof of concept. Next slide, please. Now just moving on to our Mount Lindsay project. We'll just finish up on that today. Again, Mount Lindsay, very close to our Riley operations. Next slide, please. We've been working on that since 2007. We spent $35 million. Now, for those who don't know a lot about tin, it's an important part of our fourth industrial revolution. It's all about solder, and that's the glue that connects everything that's electronic. So very, very diverse commodity, and it'll be an important part of a green industrial revolution as we move to everything into converting our economy into an electricity-based economy. So we start talking about solar cells, wind power, energy storage, EVs, recycling. Tin is a little bit of tin in every part of that cycle there. Next slide, please. And you look at the solar market, which has obviously been impacted by miniaturization, but that's sort of hit a brick wall. We're still converting from to lead-free solder. Solder used to be 60% tin, 40% lead, and now it's 96% tin and 4% silver. Now, the 5G network's going to need a lot of stations put in, probably millions of stations worldwide. So there'll be, circuitry for all of that. There'll be also, because of the billions of Internet of Things and smart devices out there, each one of those requires solder or circuitry. So that's tin required for that, and it'll be 30% more, 5 times as much tin in a EV than there will be in a combustible vehicle. So tin's very much joined at the hip with, I suppose, our future lifestyles and economies going forward. Next slide, please. And not only do we have tin at Mount Lindsay, we've got tungsten, which is a critical mineral. This drill hole's from 2008. Look up the critical mineral prospectus in the tungsten section, and you see that photo there, and Venture Minerals Mount Lindsay project mentioned quite significantly. Next slide, please. Tungsten, for those who don't know, is ranked as a critical mineral not only by Australia but by the UK, the EU, Japan, and Russia. At the end of the day, it's a pretty key component to industries vital to national security. And the US, since John McCain in 2018 and recently Donald Trump, and obviously the Biden administration hasn't changed their viewpoint there. But as end users with Europe, they are looking to reduce their dependence on Chinese production. So we are well positioned being an Australian asset. Next slide, please. So Mount Lindsay, we're looking at again. We're looking at a smaller, higher grade version with the demand in EV and critical minerals increasing. Mount Lindsay is one of the largest undeveloped tin deposits in the world. And with that, we've got a very significant portion of tungsten associated. So they very much are co-products, tin and tungsten. And we're going to focus on a higher grade one in that study, which we nearly completed before Riley became the focus for the company back in 2019. And you can see there's 4.7 million tonnes there at pretty high grade material. Next slide, please. There's 83,000 metres of drilling done. It's over 60% measured indicators categories. This is, with $35 million being well spent, all the test work's been done. We've proven we've got a very high tin concentrate of 75%. Normally it sits in that 55 to 60% range. So we're very fortunate to have a premium product. Tin's at record highs. It's gone up over 130% since the 2016 lows, and tungsten's also starting to move quite significantly. Next slide, please. There's also other targets, and as you that we've been working on, I suppose, since 2014, and we've got a target along strike from Renison Bell, which is Australia's only tin mine, very significant underground mine. We've got a field, a alluvial field. We're on the same fault, same mineral, same geology. And the next slide, please. And you'll see from the next slide that we have a very much an EM target there in the bottom left-hand corner. It's coincidental, which is an EM is used as the exploration tool of choice. So, you know, we have a very exciting target there, and another 49 EM targets to look at there as well from that work done in 2018. Next slide, please. So just wrapping up, exciting phase of the company, moves from explorer to producer with first shipment from Riley. We're well positioned in terms of EV and critical minerals with Mount Lindsay, and Chalice is beginning its work to, I suppose, bring forward the potential success of a Julimar lookalike number 2 being found at our Southwest project. Thank you.
Andrew, thank you. And a lot's changed since we last had you back on, particularly the iron ore and the tin price. Did you ever expect to be in that position with pricing?
Well, look, I woke up on Friday morning and you know, iron ore was a record price and tin was a record price on the same day. But since then, iron ore's taken off even further. So we seem to have got our timing right, Tim.
It certainly looks that way. So how do you execute on that timing? You know, there's some questions here from shareholders who are obviously always impatient. How do you balance needing to capture that price with delivering on expectations?
Well, look, we're on the verge of commissioning the wet screening plant, and so expect some news flow on that very, very soon. And from that stage, once you start commissioning, you can start putting the ore through the plant, and once you get a sort of like a 10,000 tonne stockpile, you can start hauling. So we're still on target for this quarter at this stage, so it's looking pretty good. So once that first shipment comes out in June, then you'll see cash come in, and once that cash comes in, we'll start redeploying that to getting Mount Lindsay, get the permitting finished. We've got a much smaller capex scenario, probably looking at $50 million. So that's well within the capability of the Riley project. So we can potentially self-fund the build of the Mount Lindsay tin tungsten project. Yeah,
okay. There were some questions around funding. And so the idea is to get this first iron ore shipped out. It's scheduled for June, and then to use those profits across the other commodities.
Well, it'll be a nice position to be in to have that money coming in. Certainly, Mount Lindsay is our flagship project, and you know, we're looking not to raise any more capital. You know, maybe dare I say, do dividends if things go really well with the iron ore price. But you know, there's a $50 million bill there at Mount Lindsay. It's very advanced. We're a long way through the permitting. So while Riley's being completed, you know, we will look to start getting Mount Lindsay ready for building once Riley's is finished. And we have the opportunity with that money to look at either holding a position, and if Chalice is successful at Southwest project, 30% ownership there, or on other exploration assets we have in WA. So we're sort of blessed with many things. We also have the Livingston project, which has 500,000-600,000 tonnes. We could mine that and maybe get a third year of iron ore production if the iron ore price is still there in 2 years' time. So many multiple opportunities. As I always say, when you've got money, you've got plenty of options.
You're certainly spoiled for choice. The market doesn't seem to be giving much value to Golden Grove. Can you tell us a little bit more about that?
Well, look, Golden Grove, we're out there drilling our second phase, and we got a fair bit of attention back in November last year. We hit that, November, December, we hit 7% zinc, a couple of grams of gold, percent copper, and then 0.5 ounce of silver in our first RC program, first bit of drilling at Golden Grove. But as was the situation, the historic Golden Grove mine just to the south of us, it's deeper drilling is the answer, and that's what we're doing with the diamond drilling at the moment. So, we're obviously those holes are going in the ground at the moment, so expect some news flow to come out from that. So, yeah, look, I think the attention is probably on the other three assets at the moment, particularly the iron ore and the Chalice joint venture.
And just finally, you've had this question here. You've had almost 40% of your registered turnover in the last little while. Are you attracting institutional support, or are you still too early for that?
I think it's probably still a little bit early. I think once you get the iron ore up and running, then I think we'll be poised. And I think the institutions will be very keen from exposure to tin. And there's not many tin companies out there. And our project, even though it's 40% revenue is tin, and 40% tungsten, 20% magnetite, it's a very profitable, low-cost operation. So I think very much the exposure from funds could be when the tin gets reignited.
Yeah, no, I certainly think you can expect that some knocks on your door in the next coming 6 months or so. Andrew, that's all we have time for. Really appreciate coming back. Such a great success story since we last had you on. Have a nice weekend.
Right. Thank you very much, Tim.
Next up, we have TZ Limited, ASX code TZL. It's got a market cap of around $14 million. A one-year return of up a lazy 200%. The company successfully commercialised proprietary locking technology in the smart locker and data cabinet security markets. We have with us Scott Beaton, who is the CEO. Scott, over to you. Thanks for your time.
Thanks, Tim. I'm on here. Yeah, thanks, Tim. Lucky last today, and thanks for everyone for organising today's presentation. I'd also like to welcome all investors and attendees to today's presentation. My name is Scott Beaton. I'm MD, CEO of TZ. Started with TZ back last year in March. My first day was the day of lockdown. So as you can imagine, the first couple of months in this new role was an interesting ride. Just briefly, today's presentation, I'm going to cover what TZ is, what our business, technology and hardware, our key categories that we operate in, which is retail, day lockers for office and security, mainly in data centres, and our education offerings around the mailroom and locker systems. Our revenue model, and I'll go through just some of our focuses and current priorities. Next slide, please. So essentially, when TZ started back at late 1990s, we invented the smart lock, and it was a very different proposition then because the electronics and smart access was not around. But what we've developed is a smart locking device, as you can see here in the top right-hand corner. And this is our locking device, which is low power consumption, lightweight, flexible form factor, and it's controlled by integrated microprocessors. But most importantly, it's got integrated sensors that report back to the user and managers of the locking system. And what that basically means, you've got a full audit control and user experience that tells you whether your lock has been tampered with, whether your door is opened, how long it was open for, was it unlocked, and there's many, many different signals that come back. In our data center environment, our locking devices also sense of that heat, so which is very important in case of fire. Next slide, please. So together with our software platform, which is the most advanced software platform, what basically it allows us to have solutions in retail, data center, logistics, office facilities, commercial asset securities, postal, and then we have this area of our business, which you could call it future solutions. And really that's as big as your imagination, where there's a need for a lock or access control to a particular area of your business or your home. That's where we potentially can be. Just in the bottom of the slide here, we've got different pictures of most of our different locking devices that we have in our smart locks. So basically that sums up the core overview of our business. Next slide. So where we drive revenue, we have solutions for retail click and collect, and you can see one of our clients here, UPS, and our locker solutions that we have for them. We have our business in universities where we have full mailroom and postal lockers. And then we've got our data center security, which is the bottom left-hand corner, where we provide different micro level of access controls to data centers, but it's more importantly, our clients are those clients that are in those data centers that need to control the data to the rack. And then we've got our corporate day locker solution. And you can see a picture here of Westpac and one of the solutions we have in one of their buildings in Australia. Next slide, please. The thing that really excites me about TZ and one of the propositions of joining TZ was actually its very impressive client list. You won't find any other ASX listed company that I know of that actually deals with all of these type of clients. And when you really want an endorsement for your technology, when the major technology companies in the world, such as Apple, Microsoft, Amazon, etc., Google, are buying our technology, it's a great endorsement for this for our company. And we're very proud here, being a little Australian listed company, to actually have these type of clients. Next slide. So basically, I'm just going to go through as quickly as I can to break down part of our business model. So basically, where there's disruption in the marketplace, a lot of the disruption in those providers also need some sort of access control, locking device, or some sort of technology solution to drive that. So typically in the retail sector, if you go back 50 years ago, if you wanted something to buy, you'd go to a store and you'd try to find it. So basically, it was the model worked well, but there was issues around supply, etc. So with the TZ model, what we've got, we provide to retailers plenty of options, from software all the way through to delivery at the other end, where we can match couriers, etc., to the provider, to the retailer, where it's all about an e-commerce solution. So whether you're a large or a small retailer, obviously people can go onto the internet, wherever it is, from their smartphone, from their laptop, etc., and they can buy online. And it doesn't matter where they are, and they can buy products from all around the world. But where we then come into it, we provide, once you've gone into the shopping cart and you've actually purchased that, that's where, depending on the courier, a lot of our solutions are then embedded with software, from notifications through the delivery to you being able to use a locker bank to pick up, to collect your package. But also the other thing I would like to highlight here in this opportunity for TZ is returns is often a nightmare, whether you have to go to a store or just return by going to post. And that's another thing that TZ is well positioned with its software, where it allows many consumers to actually return their belongings using our different locker systems around the world. So that's basically covers a big solution for us. But what I'm trying to highlight here is that TZ has technology both in the hardware, being a lock and a locker bank, but also in the software that drives, whether it be linking into the courier or the notifications and whatnot that can go through to the consumer, and then going back to the retailer and providing them some tools to enhance their e-commerce solution. Next slide. I've included in this slide just a couple of examples of where, and really indicates the global reach that TZ has. So our largest market is the US. But in this slide here, I've included a slide from DSV. DSV is a large client of ours out of South Africa, and they have many different click and collect solutions and locker banks, the large logistics provider, but also their solution goes into Nedbank in South Africa, where the usage of the locker network is used for the bank to provide ATM cards and debit cards, credit cards, etc., to their clients, where where we're sitting in Australia, we probably don't recognise that to get those solutions out with mail theft, some of their clients not having mailboxes, maybe even physical addresses, it was actually an issue for the bank. And so, and the other one here I've used is Westtrack, which they're a Caterpillar reseller here in Australia. And I've included this slide here to really show you how impressive our solution is in there. So when I actually visited their distribution centre here in Sydney, I was blown away of how big it was and just the size of this operation. And then to see that the amount of people that were coming and collecting different packages from there was just, I just never expected it. And our solutions, as I was saying here, it goes from ordering online to notifications to a pickup, whether it be in the locker bank, as you can see on that bottom right-hand side picture, or alternatively, if you go in and you pick up from in-store, also our software solution is embedded all the way through the solution. So more importantly, how do we make money? So we make money from selling hardware such as smart locks and electronics and the physical locker. But then we have our software platform where we have a hosted option where clients will take their own hosted solution, or we have our own cloud-based, SaaS-based solution where we sell that way. Our other way we make money is by hosting solutions and ongoing software and hardware maintenance. And we also have a lot of our clients, particularly on the back, well, I shouldn't say the back, but staff going back into the offices, particularly the large clients in our day locker suite, where we're getting bespoke requests coming through to amend the workflow and how people will access and use the locker. Next slide, please. So I've just tried to give you a summary of just parts of our business because we only have 10 minutes. But just some of our financial highlights here, also what the drivers of our business, and then I'll go into now just the financial highlights. So basically, our business in our first half year result for FY21, we had revenue of 8.6 million. It was an 8% increase. We had the first positive result for the business with an EBITDA of 200,000. And that was a very good result for TZ, particularly from where we've come. But more importantly, what I'm really trying to highlight here in the last couple of bits is this changing way that we sell what we do in our solutions, where our recurring everyday revenue of the business, which is made up a mixture of ongoing revenue, software, hardware maintenance, but contracted revenue, has now grown to over 2.5 million. From only a couple of years ago, it was basically nothing. And we have a goal there to increase that to 10 million over FY23. Now that alone ensures that our fixed costs of the business are covered by this ongoing everyday revenue that I'm talking about. And I just wanted to highlight here just a couple of, just even the last 30 days of orders coming through. So the right column over here just shows you in our US business alone, just all these different orders that are coming through that we're taking. And that's a mixture from all of our solutions from day locker, postal, and a couple of clients also upgrading and expanding their solutions. And so we're on target there in our plan in the US to clear over just over US $9 million for this financial year. So that's our orders. Then we've got to deliver them. Some will be delivered this financial year and others will fall into next. But it just gives you an indication of the momentum. And in the US, unfortunately for us with COVID, a lot of these clients, really shut down, and it did hurt us last year. So it's good to see that business picking back up greatly. Next slide, please. So just a snapshot on our business. We've got just under 120 million shares on issue. Our market cap is 14.1 million with that. We have debt of 10.5 million, gives us an enterprise value around 25 million. Our share price has actually been all over the place of lately. So with COVID coming in last year, we went down to 3 cents. A couple of weeks ago, on the back of not much, we went up to 36 cents, and now we're back around 12.5 cents. So that's our capital structure of the business. Next slide. Our focus moving on. So when I came to the business, I had to do two things, in my opinion, very shortly. It was to reduce the cost of the business. We reduced it by 25%, or approximately 2.5 million. We've invested more in our core platform. And then the most important part, which is the fourth box here, was to focus on the balance sheet. That's where I'm at the moment. So we've just come off a capital raise of $2.5 billion. And that's really important to fix our balance sheet to get our debt in control. But more importantly, moving forward, because that's now, over the next, so on the back of that, we need to grow this business. We need to scale it up, and we need to get revenue. And that's where a big part of our focus now is moving to. We've done the core systems, won't bore you all that right now, but it's really growing that revenue model and expanding. And just next slide. And I really like to put out a big aim for our business and why our clients here. Why do we have Apple? Why do we have Westpac? Why do we have Microsoft? And why are so many of our solutions we provide so unique? It's because of our software platform that sits behind smart locks. And that is the benefit or the competitive advantage that TZ has. And therefore, whenever you have some complexity on the access to any door, any locker, anything that you can think of where you need to have some access control, and when you complicate it with multiple users, different hierarchy of who can give access to, that's where TZ has a software platform for many of our clients. And I'll leave it with the next slide, is just really a bit more of a teaser. But these are some of the recent, this is only in the last month or so where we had different clients come to us looking for different solutions. So the top left-hand corner, I'll do it quickly, is a gun cabinet for, well, I won't say who, but was for a police force. So if you can imagine, can't really see it there, but there's some high powerful guns in the back of that you don't want anyone just walking and getting access to. We have these large cage requirements that's come to us, which is the middle, top, middle, and right solutions for much bigger parcels that can be used, whether it be something like Coates Hire or a client like that, or Bunnings that have different flat packs that they're trying to deliver. But the other one that excites me is the one at the middle that's come through is, unfortunately for New South Wales, they're illegal to use these things. But a problem for many offices at the moment is all around the world is staff coming in on electric scooters. Where do you put them? It's an OH&S issue. You can't park them at the front. You can't leave them. And so we're getting all these requests, mainly out of Europe, asking for these type of locker banks. And then the last right one there is actually a really simple one, is how do you lock down different cabinets in a house and office, particularly when you've got small children. And that's one of our, that device there. I'm very excited about that because I believe there's a lot of opportunity for that around the office. So that's just for you to more of a tease and have a think about how far TSET can go from, say, a locker to more closer to the front door. And back over to you, Tim.
Thanks, Scott. Quite a few questions here. Now, the company has been around a long time. Can you give us a little bit more colour on the substantial shareholders, which kind of number around almost 50%, and how you're going to manage the debt load moving forward?
Yeah, really good question. So, I mean, the way I sort of look at TZ, we're really in version 3 of the company, and it has, as you said, it's been around for a while. And this version of the company is taking what we now know is what is our original smart lock technology, mix that with different modern technologies like your mobile phone, different access controls you can put over. That's really created the company. So I'd like to say that we're in version 3 and we're commercializing the business, as you can see. And that's really been, we're probably on about the six years of that journey. So to answer the question on the debt, the reality is that's one of the things that stood out to me. It was a barrier for me to jump at this role to start off with. But when we went through it, our debt is with our largest shareholder that owns, well, now they're a little bit lower, but about 20% of the company. We're doing a rights issue at the moment. That debt holder, being First Hamlet, agreed to take up their rights. And 100% of this rights issue we're doing is to raise just over $7 million. 100% of those funds are used to pay off debt. So if you take 7 million off approximately just over 10 that we have now, that puts us in a much better position. And for a company our size, having a couple of million of debt, I think is sustainable. When I came into the company, the market cap was 6-7 million, and we had just under $12 million of debt. So we just paid down a little bit of it as well. So that was unsustainable for a company our size, and it cost our company dearly. We lost opportunities because clients looked at it and went, love your solution, you're number one, but we can't risk going with you.
Yeah, understood. And can you talk a little bit more of the advantages of the software platform? I mean, you kind of got the hardware, which is the lock. What value add does the software?
I completely understand. The hardware, the good thing when you provide some hardware is that's the thing that people see. And software is that thing, if it just works, you don't really understand it. And when you really come into, you think of our clients, imagine you're in Westpac and you've got 26,000 lockers to manage. And then you've got all your staff that might be coming from interstate that need a locker for the day to put their suitcase, a laptop, etc. You have clients like Apple that lock down prototypes behind different locker systems and, secretive like them. How do you make sure that your prototype, where it is, who has it, and if it's not with somebody that it's sitting in a locker? So what I'm saying there, that creates complexity, and you've got all this different workflow and hierarchy that sits behind it. And then at the same, and I'm talking about a day locker here, and therefore you need to have a system that you can manage your access controls, and in most of our cases, a locker system. Imagine you put the complexity on a postal locker where multiple carriers are accessing a locker, and then you don't want a $3,000 laptop, somebody just randomly coming up and getting access to that locker and go, great, this is a new Apple iPad or whatnot. So when you think there's complexity that sits behind multiple hierarchies, who can access when, and particularly around an asset as well, that's where you have complexity, and that's where our software platform wins. And all I know I'm the MD of this company, I can say it, but look at our client list, that's the endorsement.
Yeah, understood. And those clients, who is your ideal client, given, there's added costs when you have to tailor different solutions for different clients?
Yeah, I agree with that, but I would like to, we have a core platform, right? So just because a client wants to adapt workflows, a lot of those tools they can do themselves or they can outsource it, but the core platform is a standard. Well, we have different platforms with different needs, but we have core platforms. So you're right, it is expensive doing standalone systems, but when you have your core platform and the different way with technology is developed, it's a lot more scalable now.
And how does your sales cycle work? Who do you've got a big sales team? Who's your first call?
Resellers. So partnering with, when I say resellers, so again, it depends where it is, but we're talking about day lockers here or the office, if you partner with the managers of those buildings, so your CBRE, those type of JLs, that's one way. But then there's other times, depends if it's new building being built or not. Sometimes you need to go with the facility managers as well, which links into JLL, depending on the size of the business. And then you have other clients that are large that might take up, let's say, the main building. They might take up half the floor. Then you might engage them, and you actually engage them through the office furniture is a big part of it, actually. So there's many different routes there. So, and to answer this question properly, US, we have a big sales team that goes direct. And that's because a big part of our US business is the university system. If you want to see more about that, we do have a video on our website with that solution with Fairfield Uni. But that is a big addressable market, but one that we've got a lot of people on the ground. And then we partner through over 50 resellers in the US. Our strategy in Europe is purely reseller. So we have our CTOs just relocated there. So we have a man on the ground there that technically knows our product or not. And we give all of our solutions or marketing, etc., through to the resellers. And here in Australia, because it's our home market, and it is, to be honest, it's a much smaller market. So a lot of the sales team here, it's actually the founder, myself, and one other that actually focuses on the Australian marketplace. But we do have an established client base here in Australia. They're just the bigger companies.
Understood, Scott. That's all we have time for. Really appreciate your time. Have a nice weekend. We'll see you again.
Yeah, thank you very much for having me.
Thanks, everyone. As I said, that's all we have time for. Have a nice weekend, and we'll see you next week.